Nasdaq's down a full percent, and that's dragging some of the S&P down with it. Let's get to Bob Pisani. Hey, Bob.
Yeah, mixed open. Industrial still holding up a little bit better. Definitely mega cap tech a little weaker. Just take a look at the sectors here. I just call this a mixed open here with energy up slightly, healthcare and banks again doing a little better after a terrific rally yesterday in the bank sector. Tech's down slightly. Communication services largely because, of course, you have Alphabet in that particular group. If you look at the mega caps, all down here, led by Facebook, was down about 2% about 4 or 5 minutes ago, somewhere around there. Apple just turned positive. That's interesting. That was negative at the open. Amazon, Microsoft, Alphabet, as you see here, all to the downside. I think the most interesting thing is to look at how fast these cyclical sectors have moved. I noted yesterday, particularly industrials, we hit a lot of new highs yesterday and again today. Big names, Caterpillar, Illinois Toolworks, Honeywell, Sherwin-Williams, Deere, Johnson Controls, Sherwin-Williams, Packard, Cummins, just a long list of industrials at new highs. What concerns me is the multiples, because we're pricing in perfection here. These stocks do not normally, Honeywell doesn't trade at 25 times forward earnings. These are all at the highest levels in more than 10 years at this point. Honeywell trades 15 to 20 times forward earnings. So what's the street saying? Well, you know, you get an expanded multiple when the economies traditionally expand. Okay, so that's exactly what we are getting. But these numbers are really frothy. They are really well out there. So we're going to have one heck of a recovery here. And also, at some point, a much greater push up in earnings than are currently being anticipated. It's not quite the same, but getting there with the banks. Obviously, they haven't rallied to the extent that the industrials has, but even some of the banks, the regional banks, are trading at higher multiples than they have had in the last several years. I know this is not the only metric you use with bank stocks, but it's a useful way to look at things. U.S. Bancorp at 14 hasn't been there in several years. Fifth Third, PNC also starting to get a little bit elevated here. My point here is that the street is starting to price in a normalization of the economy in 2021. And you can see it here. Look at these earnings estimates for the S&P 500. This is the whole S&P. 2019, we had 162. This year, we go to 136. 2021, we have 168. It's back to normal again. Not only back to normal, we're above where we were in 2019. The street believes suddenly everything is going to sort of go back to 2019. Well, I hope that happens, but there's an awful lot of hopium priced into that particular estimate, particularly when you start looking at things like industrials. Yes, airlines definitely have a lot of room to go. Energy does, but a lot of these groups starting to get a little tough. Now, the guys mentioned American Airlines here that are doing that 38.5 million share stock offering. So that'll increase the float by 7 or 8%. Who could blame them? Just remind everyone of the catastrophe of what's happened to the airline industry. 2019, we were talking $45 billion in revenues at American. Today, $17 billion. And in 2021, which is what everybody cares about, we're essentially back to, well, all right, a little better than half of what it was in 2019. That is a catastrophe. Now, here, you don't have the same concerns about prices having been pushed up. We can go a long way right here. We're going back here. Look at this. We were 25, 26, just back in February on Americans. We're still half of that. That's what happens when your revenues get cut by almost 2/3, and you're still expecting to be only half your revenues in 2021. There's a lot of room to move on airline stocks, but industrials and banks starting to get a little tighter.
Shepard Smith here. Thanks for watching CNBC on YouTube.